Tariffs plus earnings equals market declines. We have a lot to discuss today, signal changes, breakdown in the chart, so sit back and let's get started. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. I am a practicing financial advisor, working and making decisions for individuals and companies. I love the markets. Think outside the box and don't follow the Wall Street mantra of buy and hold. So if you're looking for a fresh outlook, please consider subscribing or click a link below for a complimentary review. Tariffs. We've been hearing lots about tariffs with China, and now, last night, let's add in Mexico. Markets hate tariffs. Not surprised about the China situation. Mexico, a little bit of a curveball. And then earnings. We're going to talk about that again. But first, let's go over today's agenda. We're going to go through big charts and signals. Lots of changes there. Treasuries. What's going on with the bond market? What keeps me up at night? Tweets of the week on my radar and game plan going forward. Let's go to the big charts. First up, let's take a look at our daily chart. Lots of breakdowns. What are we seeing here? First off, this morning, gap down, and we are now below the 200-day moving average. Not a good thing. Momentum really broke down last week. You can see that negative crossover. And then relative strength down here broke 30. That is bearish, and we have not seen that in a while. The next thing, of course, is your VIX, Volatility Index. I've been talking about this. We've been snuggling along this 15. We're at 19 as of today. So right now, short-term signal, you're not going to be surprised, is definitely negative. Next up, let's go to our midterm signal. So we've been talking about this. Here's our weekly view. Started to see a head and shoulders. We talked about this in our video mid-month, and guess what? It really continues to form. Not only that, tough to see here, but if you look over here in our zoom in, we've had a negative crossover on momentum, and we broke, in this case, I look for the 40-week average, and we have broken that today. That is not a good sign. That is also giving me a negative signal, which is going to make me make changes today, which I will discuss in a minute. So next up, how about our monthly view? Well, no surprise here. I've been negative on the long-term view for quite some time. Why? Because of momentum, right? Momentum has gone negative. We kind of came up, and you can see a little bit better over here on the zoom in, came up but failed, okay? Not only did we fail, here we go again, looking in close over here, we went below the 12-month moving average. We are negative. So all signals are negative right now. So let's go behind the charts and look at some data that's going to continue to support all of this. First up, 50-day moving average, S&P below 40, bearish. You've got NASDAQ about 30, obviously bearish. Below 40, bearish. Above 60, bullish. Mids, 20s. And then we've got smalls in the 20. How about the 200-day, which is the longer term? What I'm looking for here is a move, again, below 40. Now, this chart's updates at the end of the day. So it's through last night, the 30th, and we're recording this live early on Friday morning. So we're about 50 right now in the S&P, but we've had a breakdown in both mid-cap and small-cap. That is not bullish at all. Let's take a quick look at bonds, treasuries. So it wasn't long ago, I called this the most important chart of 2019. Right, here's your 10-year treasury. Why? You can see the trend line going back to 1980. And we broke it for the first time, really, since 2000. Now, what's happened is, had a bet with my friend at the gym, Perry. He did not believe me. I said we go below 3%. Last night, again, another chart that updates at the end of the day, we opened up today 2.17 on a 10-year Treasury. I had a 230 to 225 outlook, and now I think that we're going to see probably a little bit of a bottom here. I mean, we really have some oversold conditions, but then I think we still go lower after that. So let's take a quick look at yield spreads. Continue to follow this. Real good recession indicator. Kind of flat here. 0.16 continues on. But the big thing that I see here is your 5-year has now broken below your 2-year. That is very unusual. Again, this is this flight to quality that we're seeing. Bond rates are getting pushed down because of people being concerned about the global slowdown. And one thing I want you to look at, we worry about our treasuries. Let's look at some of the other countries. You've got the UK at 0.90. You've got Germany at minus 0.18. Japan at minus 0.00. If you can believe this, we have 14 trillion in negative interest rate bonds out there. That is not a good thing. Let's move on to what keeps me up at night. So what keeps me up at night? That's that macro data underneath that I've been talking about for a while that has been deteriorating for some time. One of the reasons I've been more on the conservative side. Here, BBB rated corporate debt. You can see in 2008-9 where it was. How about a 400% increase? We're starting to see some defaults here. That is a big concern. Auto loan delinquencies surge. You can go back here to 14, see it come up. We're basically where we were in Q3 2009. Earnings. This is my big thing. Again, underneath, this is what has concerned me. When you go from 24 to 12 to 1.55% after last night, 483 companies reporting from our friends at Hedgeye. I like that one. But you talk about a earnings recession. How about negative 6.25 in tech? That is an issue going forward. And it will be an issue going forward if we run into that earnings recession. China deal, right? Obviously, we've been talking about this. Consistently, I have said, we're not going to get a deal. They have their plan. They don't like America. They will not make a deal with us. And now they're going to sit back until the election because they can, and they'll just flood their market with liquidity like they did last week and hopefully keep things moving. But I got to tell you, tariffs are bad, but that's not everything. Here's my data from this morning around the world. Look at all that red, okay? India, Germany, Italy, Turkey. This is GDP going down. Consumer confidence. Across the board. This is the global slowdown. This is the data that I see every day that keeps me up at night. Next up, tweets of the week. First up, Tavi Costa, had him in a couple weeks ago. Link below to his Twitter handle. Gold to oil ratio surging after retesting a multi-year support line. Watch this ratio. Previous breakouts also coincided with major global financial crises. Hello, pay attention to that one. Next up, Mark Yusko. Great follow. Morgan Creek Capital on CNBC all the time. The four horsemen of the growth apocalypse. That is not a word, and it took me 7 takes to get that. I kid you not. Are all heading for the hard deck, and when all four decline simultaneously, odds of recession are quite high. 10-year, Dr. Copper, Kospi, Japan, oil, risk happens fast. No doubt, Mark. Jesse Felder, the debt to EBITDA ratio sits at a whopping 46%. Anytime that ratio has exceeded 40% over the past 35 years, the high-yield corporate default rate spiked over 10%. Have a link to this as well as the article that he mentions. Next up on my radar, game plan. Okay, so what's on my radar? First off, where have I been this year? No secret, I've been underweight, high beta, high risk, equities, tech, etc. Large cap, things like that, mid, smalls, emerging markets. Really, this is where I've been pretty much consistently all year, have added during the year, but really interest rate sensitive, late cycle sectors, utilities, REITs, right? REITs number one performer this year, home construction, communications, healthcare, gold, large value, and large growth. A couple reasons is I did not believe this recovery here, this V shape, so I've been more conservative in low beta sectors. And you can see from our high back in April 22nd what's happened. Here's low vol, up 1.53, high beta down 9.4% since our high, and that explains a lot. So going back, when I look going forward and what I've done, first off, last week we got our first signal. We sent out a letter to our clients and we raised cash. We did our first short last week, okay, and we started selling. We sold large growth from 15 to 5%. That was the main move that I made last week. I'm ready to make moves again today. I'm going to add another short, okay? I'm going to continue to raise just a little bit more cash, and I'm going to cut large value as well. I'm going to stick with these sectors and do the shorts. What are shorts? It's a hedge, right? When you think of a hedge, it's an asset class that's going to help you in volatile times. Cash is a hedge. Like it or not, right now we're getting about 1.6 in cash. It's a hedge. Why? Because it's not going to be volatile with the market, right? It's not a big move, but at least you're consistent. The other hedge is you can short. You can short individual equities, or you can short the market. You could do a Google search for short ETFs. It'll give you a list. You can short financials, communications, coffee, whatever the case might be. I personally use two shorts. The first one I added last week was a short S&P. And today I'm going to short the NASDAQ 100. So what does that actually mean? Hopefully I can draw here on the screen. Essentially it has the potential, if the market goes down, your shorts will go opposite, inverse of the market. Now understand, here's my compliance, there's some additional risk here. You have to be careful. I follow this. I've got all kinds of signals and research to get me to that point, but hopefully that hedge, if the market goes down between my cash and my shorts, so like back in the fourth quarter, when the market was down significantly, we were really able to reduce a lot of those losses based on our cash and short positions. Wrapping things up, fear and greed. 35 2 weeks ago, 24 this week. Not surprising indicators. Negative, 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 which is why I'm making changes. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV. All right, so what's on my radar? Radar. Okay, and then down here you can see, over here, support line. Watch this ratio, previous, woo! Slow down there, Tommy. The four horsemen of the growth, the four horsemen of the growth apocalypse.